This last section of this chapter deals with making adjustments, setting asset allocations for a portfolio, and then making adjustments to the portfolio based on either changes in the mindset of the investor, how does the investor feel about risk and return, or adjustments based on changes in expectations for the market or the value of the portfolio, the different sections of the portfolio. So let's take a look at different ways that we as managers can approach setting and adjusting asset allocation in a portfolio, a client's portfolio. All right, so the investor's mindset is a critical determinant of the appropriate level of risk in a portfolio. Some investors are risk seekers, and these investors will require less diversified portfolios. When you sit down with a client or a couple, you have to discover, you have to go through conversation to determine what their mindset is regarding risk and return. Some clients are risk averse. They're scared of risk. They typically want a portfolio that is less risky than what is optimal. Okay? Both types of investors need to be saved from themselves. As a manager, if someone is a risk seeker, you may have to throttle them back. If someone is risk averse, you may have to push them a little bit out there on the risk curve. All right? So let's go through different asset allocation strategies. So we'll start first with strategic asset allocation. This is an approach, and it assumes that the investor objectives and constraints and capital market conditions are pretty constant over time. So the investor has a long time horizon, and their attitude about risk and return really don't change much. And you also assume that the market stays pretty much in balance. And if you believe these things, then you use strategic asset allocation. What is that? That means you establish long-term asset allocation weights, and you maintain them over time. Okay, so maybe twice a year you rebalance the portfolio back to their original weights, and things really stay pretty stable and constant in the portfolio over time. Not a lot of activity in the portfolio. And that's where I am most of the time. It really depends on the client. Okay? Then we have insured asset allocation. Okay? This assumes that investor objectives and constraints change. And this happens to investors at critical points in their lives, like when they get married, like when they have children, like if they get sick, like if their parents need help, okay? Like when they reach retirement. These are all critical events that change investor objectives and constraints, okay? And also, investor constraints and objectives can change in response to the portfolio value, how the portfolio value changes. Okay? It also assumes that capital market expectations stay relatively constant. So what you expect to happen in the market stays constant, but the investor mindset changes, and it can either change due to changes in their lives or due to changes in the portfolio. Okay? So asset allocation changes when the portfolio value changes. Okay? For example, if the portfolio increases in overall value, thus creating greater wealth for the client, this would imply under this asset allocation strategy, this insured asset allocation strategy, greater ability to assume risk. The wealthier the client is, the more risk the client can take on. What does greater risk mean? It means more stocks. Okay? Therefore, it suggests a higher stock exposure. If, however, the portfolio declines in value, thus decreasing wealth, this implies less ability to assume risk and therefore lower stock exposure. So the value of the portfolio, changes in the value of the portfolio, will determine your asset allocation. And with insured asset allocation, you follow the value of your portfolio up. So if your portfolio increases in value, you buy more stock. If your portfolio decreases in value, you sell more stock. Okay? The exact opposite of this is tactical asset allocation. Tactical asset allocation. It assumes investor objectives and constraints are constant, so those don't change, but capital market conditions change. What prompts you to change the asset allocation in the portfolio, and it is your expectations for market conditions. Okay, so this change is based on the valuation of the asset classes again. Therefore, the asset allocation mix is frequently changed. This is more like market timing or rotation. It's based on the relative attractiveness of the stocks and bonds. How do stocks and bonds look compared to each other? Cheap or expensive? There's a little more market timing involved with this. Okay? When the equity risk premium rises, which means the multiple goes down, stocks get cheap, okay? The stock allocation should increase. This is the opposite of insured allocation. Insured allocation is if stocks go up, if the multiple goes up, then you buy more. With tactical asset allocation, if the multiple goes down, you buy more. Okay? So this is contrarian in nature. So insured allocation is momentum investing, and tactical asset allocation is value or contrarian in nature. When the equity risk premium shrinks, okay, that means the multiple goes up. Okay, stocks look expensive, and using tactical asset allocation, you sell. So as your stock portfolio goes up, you trim it back. That tends to be more of the way I manage portfolios. Okay? So the asset allocation decision is a function of your assumptions. Okay? If you believe that the investor objectives and constraints change, then you use integrated or insured, tactical or insured. If you believe capital market conditions change, you use tactical. Okay? If you believe neither change, everything's constant, you use strategic asset allocation. And you can combine the techniques. You can use mostly strategic and then fine-tune around the edges. And really that's what I do as a portfolio manager. I set a long-term asset allocation, and then I fine-tune that allocation over time, okay, based on what's happened with the client, based on what's happened to the markets, and based on what's happened to the values of the different pieces of the portfolio. Okay, so I will fine-tune. I might have an equity allocation of 60 to 70%, and there will be points in time when I will take it down to 60%. There may be points in time where I take it up to 70%, and that's typically based on the valuation of the market. If I believe that the market has gotten very overvalued, and I am concerned that it's going to go down, then in the near future, then I tweak it, cut it back to maybe 60%. After that correction happens, I may take it back up to 70%. All right, so that's the end of our chapter on equity portfolio management, and we're going to go into bonds and bond portfolio management in chapter 17. Until then, I bid you shalom, peace.